Okay. So welcome, everyone. Thank you so much for joining. My name is Bree Rose Gallick. I'm the Senior Manager of Communications and Operations at CDFI Friendly America. CDFI Friendly America is sort of producing this event today. Our president and founder, Mark Pinsky, will be hosting and moderating today's panel. We're thrilled to see the level of response that we've received for this session, but please bear with us as we manage a slightly larger Zoom event than we initially planned. The recordings and slides for today's session will be sent out tomorrow, along with a survey. We'd love to hear what you think we could do better or differently for future sessions, or what you loved about it. Throughout the program, if you could please post your questions in the chat. Towards the end, after we hear from each of our speakers, we will moderate the Q&A section. However, we expect we won't get to every question, so we'll save the chat and attempt to answer any of the unanswered questions after. Lastly, if you could please stay on to the very end of the meeting, if at all possible. In the last couple of minutes, we'll put up a poll in Zoom of potential topics for future meetings. We'd really love to know what you're most interested in talking about. With that, I'm going to hand it over to Mark Pinsky. He's going to introduce the Future of CDFIs series and our speakers for today. Thank you.
Thank you, Bree. It's wonderful to see everybody. Thank you for joining us for the first monthly Zoom event on the future of CDFIs. When we planned this, we thought we were inviting 50 or 75 people for sort of a large parlor conversation. Instead, we're hosting about, we had 750 people register for what's become a sort of a plenary. And with that, I want to thank our speakers. Before I even introduce them, I want to thank them for going along with us as we went from a small conversation to a much bigger event. So I'm pleased, but I'm not surprised that so many of you are eager to talk about the future of CDFIs. There's a saying that the best time to plant a shade tree is 30 years ago. And for several years, I've been urging industry leaders to talk publicly and openly about CDFI strategy and about the things that are in front of us. One person who understood the urgent need is Charlie Hammerman at the Disability Opportunity Fund. Thank you, Charlie, for the financial support that made it possible for us to plan and carry out this first Future of CDFI event for free. Today, we're not waiting for others. We're starting to talk to each other, and that's the goal, to have a conversation among practitioners. We're starting to talk to each other in a structured conversation that will continue at least through 2026, and that I hope all of you will mine for your own purposes and for your organization's decision-making. Because we can't go back in time to talk about the future of CDFIs, and while the CDFI industry responds to extraordinary events and unusually fluid external conditions, we need to jumpstart a conversation today that is broadly inclusive and brutally honest. We assume you're here because you see both opportunities and risks in the disruption that's flowing through the CDFI industry and perhaps your organization. Our aim in this event is to generate questions for you and for your organization, for your allies and for your partners, and for the future of CDFIs. I don't expect anyone to agree with all that gets said here today or in any of our conversations, but I am sure that everyone will find points deserving more thought. Our goal overall is to help you grapple with a range of important topics so that you and the industry can choose how to take the next leap forward. And I want to say I have no doubt, after 40 years in the industry, that CDFIs will do great things for decades to come. Your work on that starts now. I think about the CDFI industry and CDFI industry strategy against the backdrop of the planning model I developed 25 years ago while I was leading OFN that led to the strategy known as Grow, Change, or Die. That strategy at its core was a call for industry scale, and truly national geographic CDFI coverage. In the simplest terms, I want to say that strategy is the work we do to prepare our organizations for the future beyond our own tenures and beyond our own effective daily reach. Strategy depends on the ability to know what must never change about our organizations versus what must change to stimulate progress. If there's an interest, we will include in our monthly Zoom events a program on strategy and strategic thinking. Now, let's get to our program. Today, we're talking about CDFIs at a crossroads, taking stock and taking action. We have three exceptional and insightful leaders to learn from, all with experience in and around the CDFI industry. I'm grateful to all three of them for joining us and being part of this conversation. I am not going to take your time right now with long bios. Bree will post links to their LinkedIn profiles in the chat, but I do want to introduce them briefly. And I'm going to introduce all three and then we'll get into it. Over the past year, Diane Yentel of the National Council of Nonprofits has led an historic campaign to lift up, preserve, protect, and advance nonprofits and the nonprofit sector. When most advocates in and around our sector grew quiet in early 2025, Diane, who was then new in her current job, stepped up in a way no one could have expected. The CDFI industry needs to support and learn from Diane's leadership. Aaron Seybert of the Kresge Foundation thinks about the future of CDFIs at the systems level and with deep curiosity about a wide range of critical issues that we've asked him to talk about. We want him to offer a CDFI-centric context that will serve us not only today in our conversation, but throughout the future of CDFI's conversations we will have throughout 2026 and beyond. Third, 3 months ago, Oswaldo Acosta of City First Enterprises and I published an opinion piece in the American Banker saying the CDFI industry is due for a reckoning. Oswaldo is a transformative CDFI leader and practitioner with a bold strategy that he's acting on now. CDFI strategy must always be rooted in CDFI practices, CDFI experience, and CDFI markets, and today Oswaldo will help us to do that. So let's get started. Each speaker will try to keep to about 10 minutes. We want to leave time for questions as much as we can, and as Bree said, we will follow up with any questions we're not able to answer. But we ask you that you put your questions in the chat, as Bree said, and we'll get to as many as we can while we're on the call today. We are recording the call. As Bree said, we will send the link to the recording to you to share with others as you see fit. So let's start. Diane.
Great, thank you, Mark, and hello to everybody. It's nice to see a lot of familiar names and familiar faces here today. And Mark, I appreciate the opportunity to be here and appreciate your leadership as well. So as Mark said, I'm Diane Yentel at the National Council of Nonprofits. And so for those of you who are not familiar with National Council of Nonprofits, or NCN as we call ourselves, we exist to champion, inform, and connect nonprofits across the country to protect and advance the sector, to support nonprofit organizations in maintaining and expanding the essential work that you do every day in all of our communities. And at NCN, our most essential partners in this work is our network of state and regional associations of nonprofits. So we have 55 state and regional associations throughout the country. And together with them, we have a combined membership of 33,000 nonprofit organizations, making us the largest network of nonprofits in North America. And our membership keeps us grounded in both the reality of how this current moment is impacting nonprofits across the country, how it's impacting the communities that we serve, and grounded in a really deep understanding of how essential nonprofits are to all of our lives and to the lives of all Americans. And for our members, for all of you, those of you who are nonprofits yourselves, or for the nonprofits that you're working with, certainly 2025 was a year of tremendous consequence. In the last year, nonprofits absorbed challenges and threats really unlike any before, and challenges to the degree that I think if we weren't living through them, we wouldn't believe it was happening. Over the last year, we had dozens of executive orders and other executive actions to strip essential funding from nonprofits and communities, to gut the programs that funding supports. We saw attempts by the administration to wrongly label important diversity and equity work as illegal. We've seen a vilification of nonprofits, especially those working with some of the most marginalized, most vulnerable people in our country. We've seen hundreds of nonprofits targeted with invasive investigations and threatened with baseless criminal charges. By my count, there are now at least 330 active public investigations into nonprofit organizations. And there's likely at least as many that are not yet public. These are investigations by the administration and or by congressional committees. We've seen coordinated campaigns to smear nonprofits through the media, through congressional hearings, and through continual harassment of nonprofit leaders and organizations. And just in the last few months, we saw really an escalation of this harmful rhetoric and harassment, with some in the administration, some in Congress going as far as using the words domestic terrorism and nonprofits in the same sentence. So it really has been a year like no other. And it's important to recognize that these challenges and these threats to nonprofits aren't random or separate. They are part of a coordinated strategy to erode public trust in nonprofits, to overwhelm defenses, and to create fear. And with that fear, a chilling effect, a self-censoring or an ending of important work. And all of this because of the singular role that nonprofits play in our communities as independent voices and advocates. Our independence can be a threat to those looking to control and manage a narrative that suits a political agenda. So I have been doing this work for and with nonprofit organizations for nearly 30 years, and I have never seen a moment where the threats to the sector were so immediate, so widespread, and so potentially devastating. So it's been clear to us at the National Council of Nonprofits from about this time last year that this moment would require us as an organization and we as a sector to act very differently to withstand these attacks. And I've also felt really strongly from the beginning that our acting in new ways in defense could allow us, in fact, to not just withstand this moment, but to emerge from it strengthened. And that's just what we're doing. So early in 2025 at NCN, we implemented a 4-part strategy to work with the sector and for the sector to meet the moment. And I'll share briefly the 4 parts and some examples. So the first part of the strategy, our meeting the moment strategy, has been a legal defense strategy. The National Council of Nonprofits has now filed 4 lawsuits against the administration. The first lawsuit we filed was only the second filed against this administration. We filed it 1 week after inauguration, and that was the lawsuit to the attempt to freeze all federal funding overnight. And that is in NCN's 35-year history, we have never filed litigation before, much less as the lead plaintiff against a sitting administration. After that, we filed 3 other lawsuits, one to prevent a freeze in funding from the Inflation Reduction Act and the Bipartisan Infrastructure Law, some important housing funding that was frozen there. We filed a lawsuit to prevent the administration from stopping food assistance during the government shutdown, and we've filed one to protect nonprofits' ability to participate in the Public Service Loan Forgiveness Program. For all of those lawsuits, where the courts have ruled, they've ruled in our favor. So there are nationwide preliminary injunctions still in effect on 2 of those lawsuits, preventing the freeze from happening, and the government was forced to provide food assistance during the shutdown. Those lawsuits are ongoing, so the administration is appealing the preliminary injunctions and will be in court again in a few weeks on several of those lawsuits. And we'll continue to see them through to the highest level, as we did with our SNAP lawsuit that went to the Supreme Court twice in a week, to see them through to positive outcomes. We're also prepared, when and if necessary, to continue to file litigation to protect the sector, and we're providing nonprofit organizations with resources that they can use to mitigate risk and continue their important work. The second part of the strategy is around communications. So really at the root of all of these threats and challenges, part of what's making it possible for those who are looking to harm nonprofits to do so has been this narrative, this coordinated narrative campaign that, I would say really started among what I would have called the alt-right on social media, led by Elon Musk, who ended up being in a very influential position, of course, in the White House. And this narrative about nonprofits has really, really spread quickly. So we saw that we needed to counter that narrative to tell the incredibly important and compelling story that nonprofits have to tell about the good that we do in communities across the country. We started that campaign that we have since launched with some research because we wanted to understand, was this harmful narrative campaign attempting to convince Americans that nonprofits are bad and not to be trusted? Was that actually penetrating? Was that getting through to the general public? So we started with some research, some polling, and we found that yes, that harmful narrative absolutely was penetrating. And there are a lot of fascinating results from that research, but one that sticks with me was finding that Republican voters, when asked if they felt that nonprofits should be investigated for fraud and abuse and waste, 75% said yes. That is a big change from the very long-standing bipartisan support that nonprofits have always enjoyed. So we launched a campaign in the summer called Nonprofits Get It Done, to tell the story of what nonprofits are doing in communities across the country. And so far it's been successful. We've had about 55 million impressions from a very small media buy. And it tells us that the campaign is really breaking through the noise in an exciting way. And we have an opportunity to lean in and use that campaign to shift the public perception back to one where it broadly supports nonprofit organizations. And if we can have that shift happen, then everything else we need to do becomes possible. Our third part of the strategy is advocacy and education about the work of nonprofits. And despite the environment, we did have some big policy wins over the year. And then the fourth is on safety, security, and wellness, because with this environment of heightened rhetoric and threats to nonprofit have come heightened risks to security for leaders who speak out and for organizations that continue to do work that the administration opposes. So we put a lot of time and effort in making sure that, above all, nonprofits can remain safe and secure in doing their work as individuals and also as organizations, that we're able to protect the important missions of what nonprofits do. So looking at all of these efforts and those of partners of ours like Democracy Forward and many, many others, the overall trajectory is that nonprofits are not only sustaining ourselves during this historically challenging time, but we are strengthening as a sector. Smaller nonprofits are struggling for sure, and we shouldn't emphasize that. And things may get worse before they get better. But with these new tools that we've been utilizing, with our new communications strategies, with new partnerships and new unity that we have all been enabling and participating in across the sector, all of that has meant that at a higher level, we are going into 2026 stronger and more prepared, certainly, than we were, and with a lot of momentum for us to continue doing work to both defend and strengthen the sector. So, Mark, you started it off by saying that this conversation, that what is most needed in this moment are conversations that are broadly inclusive and brutally honest. And I couldn't agree more. So again, I'm really, really glad to be here and look forward to the other speakers and to questions later in the conversation. Thank you.
Thank you, Diane. And I already know that when we get to questions, any thoughts you have that you can share about what you're planning in 2026 that CDFIs should or could be involved in is going to be top of mind. So let's turn to Aaron. Thank you, Aaron.
Thanks, Mark. Can you see the screen?
Yes.
Great. So again, thanks to Mark and Debris and the CDFI Friendly America team for starting these conversations. We got a lot to talk about. I'm going to try to, in true philanthropy fashion, sort of zoom us out into the ether, and at least share with you how I've been thinking about the challenges in CDFI land, the community development, and nonprofit world writ large. And I really want to lean into a couple things that Diane said about coming out of this moment stronger, but being willing to do things that we have not done before, because that's what the moment calls for. So, in my own mind, my simple mind, I've been really trying to ask myself is what are we doing here? What are we trying to do here in the foundation space and community development in the city of Highland? And I would have said many of you were there at the sort of beginning of the sector, at least in the 90s when we got formalized, but we've been around much longer than that. My take on this was the sector was formed to basically complement a relatively thriving economy and sort of economic engine that was so the envy of the world. Now, to be clear, a lot of people who were not allowed to participate in that envy and have been shut out of the sort of economic growth in the U.S. for a long time. And we operated at the margins of that system to try to provide on-ramps, into what was an otherwise thriving and relatively successful system. Again, knowing that some people were shut out completely from it, so it did not work for everybody. I think that that has changed pretty dramatically, and particularly since the 1980s. And I think what we are facing today is really about inequality. So we've always had this problem between the sort of haves and have-nots. But if we can't seem to get the slide to advance, there it is. But if we look at the sort of charts, I pulled this from the CPB and then some work from Pew. I mean, I don't think this is news to anybody that the top 10% of US households control 67% of wealth. Top 1% wealth share rose from 22 to 39%. We've had massive wage stagnation at the sort of 50 to 60% AMI and below. And the chart at the left, which is really compelling to me, although a little difficult to interpret, what this is showing is what has real wage growth been? This is wage growth net inflation for income percentile earners from 1973 wages up. So, for example, on the 95th percentile, you've seen a 210, 215% real wage growth, the 95th percentile of wages from the 1973 base point, where at the 20th percentile, you've basically seen almost no growth or very, very flat, 10, 15% over that period of time. And so, those two things feed each other really dramatically. People are at the lower income brackets are making less or flat money. Inflation has gone up, and the highest wage earners have taken more and more of the share. And what was an economic engine for prosperity has now become an economic engine for inequality. And I think that that is rippling down through our sector today. It's in our politics, it's in our housing policy, it's in our, everything. Everything is built on this lopsided K-shaped recovery and economy that is driving more and more pressure down on the nonprofit sector, more and more pressure down on the CDFI sector. And we are being asked to cope with and find solutions for a population that is increasingly shut out of the economy. And this is the challenge that we have to face. Now, CDFIs are not going to solve that alone. We're a relatively small portion of the overall US economy, but I'm going to argue that we're a very important part. So, sort of moving on to, we know what the impacts of sort of growing inequality is. We've always had poverty. We've always had concentrated poverty in this country, but we're now seeing this economic segregation impact, which is really what is sort of I think is the dragon to slay of our day, and particularly for a foundation that works in urban centers and cities were economic engines, right? You move to a city to create economic mobility for your family, to sort of create a better life for your children. And I think horrifyingly, cities are becoming engines of economic inequality and economic segregation. And really, you're moving down the ladder in urban centers if you are poor because you can't afford access to those institutions that used to bring you up the economic ladder. And so it's a fundamentally different challenge than what we were faced with in the 1970s, the 1980s, and into the 90s. We really have to think differently about the way the CDFI community participates in the economy. And I want to focus us on battling inequality as the sort of sole mission of the sector. Diane said this earlier, and I'm not always popular with some corners of our world, but to me, it is a time to acknowledge that what we are doing is important and good and powerful, but it is not working, or it is inadequate at the very least. And if we continue this incrementalism of just a little more TA funding, just a little more FI funding, if we can get a little more bank money, we'll move the needle a little bit. And we're not getting there. The big buckets in our world, right? Affordable housing, small business lending, nonprofit lending. There are others, but I think those are the sort of three big pillars. Nobody on this phone call is going to be surprised by the sort of affordable housing crisis, right? Like you cannot go anywhere, and not hear about the affordable housing crisis in this country. And this number moves around a lot. The sort of high watermark that I have seen is about 7 million affordable rental housing units needed. Maybe it's more like 4.7, 6.2. Regardless, the sort of last numbers I saw show that basically at current production levels, we are 96 years and growing from meeting just current demand in affordable housing. And that's just on the supply side. We're not even thinking about what demand's going to be like in a decade or 2 decades or 3 decades if we continue to allow inequality to grow, where our middle income become our 60 and 50 and 40% AMI earners because the wealth distribution has skewed rental rates so much, and that we have financialized our housing stock to such a degree that we are collapsing under the weight of it. I think similarly, which is hard to get your arms around, the state of small business. I always look at Financial Health Network. They do a lot of sort of qualitative surveys. A lot of our grantees participate, et cetera. I don't know that folks could say that this has gotten much better. Small business starts have been pretty robust, recently speaking, but financial stress and access to capital in the small business space, particularly under a million, at least from their survey data, continues to show a lot of strain and a lot of really localized effects. Rural small businesses in particular struggling immensely. And then, I don't need to go into too much depth because of Diane's excellent presentation, but the nonprofit sector is in crisis, is really struggling. I mean, we have over 1,000 grantees around the country, and it is concerning what we are seeing. Cash levels are low and dropping. Access to credit is becoming challenging. Inflation is eating budgets alive. It is a very difficult time in the nonprofit world, and I suspect we're all seeing that in our portfolios in one way or another. So we can't boil the ocean. We are not going to fix this on our own. We're not sized to do so. But what can we do? I've said this to Mark. I've talked to Oswaldo a little bit about it too. From my perspective, I think that we need to think about a reorientation to the way that we are capitalized in this sector. I think we have exceeded the wildest dreams of our forebearers, sort of in the 80s and 90s, about the size of this sector, its capitalization, its access to public markets, et cetera. But along with that, we have highly federalized our system. We are extremely reliant on federal, sort of national bank capital that is motivated by the Community Reinvestment Act, supplemented by equity-like sources like federal tax credits and federal grants, with a sprinkling of private philanthropy and state and local government funding, which has allowed us to get to tremendous scale compared to where we started in sort of small faith-based loan funds. But we have created tremendous concentration risk that we are all feeling today. And that, I don't think, is serving us well. I don't ever want to argue that we need to give up on the scale because we have so many people to serve. But I do want us to think about adaptability and perhaps localization of resources. So, Oswaldo and I were talking about this earlier when we were planning for this. The CDFI world, we were private credit before it was cool, right? Like, this is what we do. That we have been private credit forever. And before it was the darling of private equity firms and asset allocators, this is the kind of work that we were doing. We were doing fintech type lending, peer-to-peer lending, social, sort of social factor underwriting, non-traditional outreach and intake methods. And we in this movement, co-ops, community serving organizations, I mean, there were mutual benefit organizations in this country before there were corporations. Right? We are the genesis. We are the natural state of affairs when markets are originally formed, right? Because we are based on trust. And that is the essence of all financial services and the extension of credit. So it's not that we can't do big things. We just have been not a victim of our own success, but I think held back by it. We need to get to some newer and bigger ideas so we can come out stronger on the other side of this. A couple straw men, which I'm not going to say are great ideas, and there's 1,000 reasons why, but I just want to try to throw a few things out there to get people thinking about what are things that we could do to sort of bring us into this next era. And one thing I look at, I've sat on the board of a large credit union for a very long time, and I've watched the decline in community banking. Particularly in places where we work in the Rust Belt and in the Midwest and through the South, where the complete contraction, and I would argue collapse in many places of community banking is extremely problematic. There are very few decisions that are made locally in the extension of credit now. And when we see this collapse in credit unions and community banks, what we're losing is local adaptability. We're losing the ability to adapt to local conditions. And it's not like there's not a demand for local financial services, right? Everybody who's sat in front of a small business owner, they want to tell you their story and how they're going to commit to the community and how long they've been here and why this community is needed. But that's hard to do when you're doing algorithm lending. And there's a place for that kind of work, but I don't think that it's to the exclusion of the kind of work that we do. So I want to challenge the sector to think about maybe the CDFI world, which again, we have CDFI banks and credit unions. Perhaps we need to think about the future of community banking in a different way. Maybe we need to be the ones buying these closed banks or taking over the conservatorship. Maybe we need to partner with industrial concerns, local governments, unions, and pension funds to create a different kind of local banking in the way that the savings and loans were created, prior to the crisis in sort of the cooperative spirit. And that's something to consider. A bit of a sort of irritation of mine is the amount of capital that state and local governments spend on economic development nationally. This is a really hard number to get your arms around. I think conservatively, it's like $50 billion that state and local governments spend annually on incentivizing economic development, which in many cases is just poaching a company from over one state line over to your state line. And it's, race to the bottom economic development. There's, of course, wonderful things that happen in economic development. And I've got lots of great friends and people that we work with who work in this space. But when I see statistics around like 70% of the incentives go to large corporations and only 30% to small and medium-sized businesses, that's a big problem. And we know what kind of fragility, I mean, believe me, I live in Detroit, right? Like I know the fragility of structuring your economy around big sort of agglomerations of sort of industry and neglecting the sort of downstream small businesses. And I think our state's done a much better job in recent years of trying to diversify that economy and support organic growth. But this is a huge market, a huge market. And CDFIs need to be in the game, helping make policy to support the kind of borrowers and businesses that we support. And then finally, we look to the public sector often as a source of capital or a solution for CDFIs because we need long-term, stable, low-cost debt to do the kind of lending that we do. But I would urge us to think about the CDFIs as a solution to the challenges of the public sector today. Many of us work in locales that are very resource constrained. They have too many problems, too few people. Every day is a crisis. And their ability to think long term and to think about capital systems in their markets is extremely constrained. I think there's a lot of bright spots to this right now. We are seeing California, New York, Georgia, places like that, where they're using tax-exempt bond dollars to create affordable housing pools with CDFIs and leveraging both public and private. But I want us to think larger than that. Can we become infrastructure lenders? Can we be conduit issuers? Can we become municipal advisors? Can we become lenders to school districts to increase childcare opportunities? Like, what can we do to solve the public sector problems and become extensions of those public bodies that are stressing under the same problems of inequality that we are stressing under? So I went slightly over, but I think that's it. And I think I'm going to hand it over to Oswaldo.
Thanks, Aaron. That was terrific. Appreciate it. Oswaldo, you're up. Oh, you're muted too.
Oh,
there you go.
Can you all see my presentation and hear me?
Yes.
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 Thank you, Mark. So I want to move us very rapidly from the excellent presentation, the political economy of nonprofits presentation by Diane and the microeconomics lecture by Aaron. Thank you. That is an excellent framing. I am going to go to the other end of the continuum, to the microeconomics of the business. I am Oswaldo Acosta. I lead the CDFIs Enterprises. Just 3 sentences since who we are. just to inform or just to share how my vantage point is informed. I will talk about from the perspective of a practitioner, more particularly, more specifically from the perspective of CDFIs enterprises, which is what I do in my day job. So we are a CDFI certified loan fund based in Washington, D.C. We serve D.C. and the Baltimore metro areas. We have served, opportunistically, we do deals in California. We've done a transaction in Philadelphia recently, and we're expanding in the mid-Atlantic, but we are in the DC metro area. Sectorial coverage we do commercial real estate, affordable housing primarily, but we also do real estate for small business. And for the last 5 years, we've done real estate. We've done clean energy and real estate in that intersection, solar and energy efficiency. Another interesting feature that I think will informs my view, and I think to a way epitomizes or reflects the sector, is the size of the organization and the rapid growth that we have experienced in the last 5 years. So we are $100 million in total assets, $80 million, close to $80 million in outstanding balance in the portfolio, but we were 13 million, 12 to $13 million in 2019. So rapid growth in the last 6 years. In a way, we resemble the sector. So real estate, mid-size regional CDFI loan fund. But I want to start off the conversation. I prepared 2 slides, high level, very conceptual, just to guide my conversation and provide some structure to my points. But I want to start off by sharing one question that proverbially keeps me awake at night. And I think this is a very practitioner's question that obviously concerns a lot of stakeholders, but it is the following. And you can see it on the screen. Is pretty simple, almost too pedestrian for us today. If subsidies don't return to prior levels, and I think it's a real possibility, given where we are, would your institution still exist in 5 years? Your CDFI loan fund will be existing in 5 years. And if so, in what form? Thriving, struggling, status quo, plateauing? So how does your institution look in 5 years from now? And I think we've been asking ourselves this question for the last 3-4 years before the abrupt change in the ecosystem, but right now it's more urgent. So the next 2 slides are a quick review of where we are, my reading, my interpretation of the moment, of the political economy moment from the practitioner's lens. And a second slide is just how does adaptation, to use Aaron's language, how does adaptation look to us? So to go through these very quickly, I think it's conventional wisdom now, I hope, to know that the last decade was an anomaly, or it was indeed what I call a boom, for the lack of a better term. We had an incredible expansive growth in the last 10 years, obviously accelerated from 2020 to 2024. 2 things converge. Policy and corporate support behind us and very low price money. That was incredibly beneficial for us to expand. I also believe that the moment is gone, that we are in a new situation. And I also believe that the shift that we're seeing now is structural. I think this is not a blip, or it's not an episodic change. I think this is the new normal. At the very best, this current moment is at the beginning of a new super cycle. The issue with history is that we cannot name it. We cannot name the current moment. It's hard to tell where we are because we're in it. I think if I can venture to speculate, I think we are at the beginning of a new super cycle where policy retreats, corporations are cautious, and monetary policy, which is very hard to predict, is not going to come back anytime soon. As a result, the success, or the operating model for success, looks very different in the new reality than it looked in the past. The implications, of course, is that we need to adapt. CDFIs need to adapt. If we take that this is the new reality, we need to adapt, and we need to adapt rapidly, and not to abandon the way we do things, but to preserve the work we do. So, how does adaptation look for us? I think there are many governing principles that we need to adopt. And this is, by the way, the work me and my team are doing, and with the active participation of my board, doing at CD4 Enterprises. I call it directional shifts. They could be pivots, or they could be a new way of thinking, a new way of emphasizing the governing principles we have. First is growth for the sake of growth is no longer an aspiration. We need to be very disciplined in the way we expand our coverage and our portfolio. We need to keep an eye on costs, efficiencies, be obsessed about the way we spend our resources, prudent in our portfolio, in the risk management of our portfolio, and more importantly, keep an eye on our financial statements, both on the P&L. We need to be self-sufficient or aspire to be self-sufficient. It should be an aspiration. And also balance sheet strength. We need to have a capital base that allows us to weather the next storm. The second piece, I think, is execution. It is a truism. Execution has always been the case, of course. But I think execution is more important now, but if I may say something controversial, that is going to be the difference between, or the differentiator between failing and successful CDFIs in the future. And in that line of thinking, a key ingredient for good execution is talent. And talent not only on credit, and loan origination, finance and accounting, and portfolio affairs, but talent in a much more multidisciplinary approach. We need to have technologists. We need to have people that are fluent in digital channels. We need to have the ability to incorporate AI to every aspect of our business. That is the kind of talent we need. And another controversial issue, or another taboo that, to my surprise, still is pretty much alive in the sector, is compensation. Compensation has been almost one of the issues that you don't discuss openly. We are way behind where we need to be in compensation. To attract and retain talent, we need to pay well. At the minimum, we need to pay at the level that our counterparts in community development in the banking sector pay. We need to be cognizant that we are fighting for talent versus fintech, obviously commercial banking, and many other sectors. And incidentally, and this is a byproduct of good compensation, diversity. Good compensation is the best lubricant for a diverse team, demographically diverse team. Then the third item, it's diversification of our capital sources. I think we are, Aaron, you mentioned this, perhaps tangentially, we are heavily reliant on CRA, on a few banks. There is, and I say this in the most benign sense of the term, we are very grateful to the work we've done with CRA lenders. We have about $50 million with them, and it's thanks to them that we've been able to propel the company to where we are now, but it's not sufficient. The model has been exhausted. We need to look beyond CRA lenders. We need to go to the institutional capital markets. We need to look at insurance, asset management, family offices. We need to move away from this oligopoly, if I can use the term. There are 15, 20 banks doing the vast majority of the lending to 600 CDFI funds. So for us to have a future, have a horizon for growth, we need to look outside of CRA lending. Of course, that forces institutions to grow faster, go deeper in technology and sophistication. At CFE, we are in that process. We're in the midst of that journey now. We're rating the company, we're aspiring to have a rating, and we are engaged with an investment bank, and we are exploring to see if there is a there for us to go to the institutional capital markets. Without that avenue, without that source of capital, there is no path for us to go from $100 million to $200 million. That is, I think, a must. Diversification on the source of capital, it's a key component of growth. To grow from $100 to $200 million, to leave the mid-level CDFI size and aspire to scale. Two more points. One, it's something that I struggle with there are many contradictions, intellectual and moral contradictions around the fourth point there. Historically, CDFIs have been the lender of last resort. We are meant to serve the people who have been rejected by the financial system, that are not captured by the mainstream financial institutions. Sometimes even funders ask you, hey, can you please tell me how many times this person was denied? And that's sort of a virtue signaling. Oh, she was denied twice, and I did it. I think that is the wrong construct. We should be the first lender that when a person is developing a shelter center in her community, that we should be the first entity they think of. We need to move from this mentality of serving the underserved to serving the economic engine of our communities. And we need to put the client at the center. We need to create a virtuous cycle where there is a healthy competition between us and for-profit players, and attract attention to that market that they're overlooking. I think it will only create a positive loop. And we don't want to be the lenders of last resort, because that also creates other negative loops in the quality of our portfolio. And the last thing I want to share is the issue of scale and fragmentation. We are 600 certified CDFI loan funds. The CDFI sector, the last figures I saw were $440 billion. The loan funds are less than 10% of that. I'm looking at this through the lenses of loan funds now. We're about $40 billion. 600 organizations with $440 billion. The median total asset of a CDFI is $15 million. It is very hard for any lender to run a profitable, sustainable organization with $15 million in total assets. The math doesn't math. So this is something that is coming to us. We need to have a conversation. What do we do with this highly fragmented sector where we have hundreds of entities doing the same thing, often in proximity? It is not an issue not without emotion. We don't have the ethos of the private sector that pushes or triggers consolidation just by virtue of seeking profit. It will be very hard, but I think it's possible. I'll stop there, Mark, and I hope these ideas and thoughts elicit some thinking, and obviously we'll have the opportunity to discuss in the next 9 minutes and in the future. But that's my reading of the moment and how I think we should move forward if we have a future as a financial sector.
Thank you, Oswaldo. Oswaldo, Aaron, and Diane, thank you very much. Help me show a little love for our speakers today. You are awesome. I thought we covered a lot, and we could cover a lot more. So, but we don't have time. Before I speak of time, we're gonna end with a few questions. Before we do, Bree Rose is going to post a poll that we have. We want to hear what you want to talk about more going forward. So we're going to just give it a minute of this. Bree, if you want to go ahead and post that, ask everybody while we still have people here to vote, and you can if you can't see it all, you can broaden the window. But just tell us which of these things are important to you and you want to talk about. And I'm not sure our speakers are going to be able to answer this, but. And as you're filling that out, I'll just tell you, we've talked about a lot of these topics, and we haven't decided what we're doing in February, but we will do a February event. So, and you will hear about it. But this will guide us. So, so thank you. Let's just give it a little bit of time.
Dynamic polling is awesome. I've not seen this. This is really interesting.
Oh, isn't it great? Well, it's great when you have a big number. When you have 6 people in a meeting and you vote, it's not so much fun. But when you have 518 people still here, it's you can actually learn something really meaningful. So as that winds down, just another 10 seconds or so for people to vote. I think we're slowing down. Oh, we're speeding up. What are you going to do? All right. So I'm going to start a question as people are finishing that. And Bree, when you see it slow down, please take that down. There are many questions. You saw many of them in the chat. I actually got a handful of questions via messaging. One question I want to ask you is banks are so important. We talked a lot about CRA and the role of CRA and how much we're dependent on that, as are nonprofits of all kind, Diane. And you can share the results, Bree, if you want. The question is, given, and this is one of the topics we could talk about, given what's going on with CRA and the decline in enforcement in CRA, that's my judgment, not other people's judgments. What does that mean for us? What do we need to do around that? So your thoughts on that? What are you seeing? What are your perspectives? Are banks still partners they used to be?
I mean, I think so, Mark. I'll say, having worked at a large bank for quite a while, I mean, I still think the banks are full of very well-intentioned, hardworking people. We got to recognize, though, that like while they are big and important to us, they are backwaters in most of the banks that they operate inside of. They are tiny little business units that oftentimes have to argue for their own existence annually when budgets are coming in. And in the climate that we're in today, the sort of social impacty work that a lot of the sort of CRA motivated groups are doing is, let's call it, less compelling than it was before. So I think we just have to recognize the fact that we have, as I said, I think over-indexed on a financing or sort of capitalization scheme that was great in the good times, but it's going to be challenging. And I think we are going to be heading into a CRA fight, in the near term. Now, whether that's fingers crossed regulatory or, abject fear statutory, we got to be ready for this. And we have to have an affirmative vision of what community reinvestment means and what we know from an evidence base tells us is the best sort of serving. And I think there is an argument to be made that we ought to be locking arms with particularly the largest banks, but even medium and small size Fed regulated banks to draw in the sectors that are eating commercial banks' lunch, right? I mean, if you look at the explosion in private credit, I mean, they have gobbled up so much market share from these banks that are CRA motivated, and they are completely unregulated and they're sort of devoid of obligation into this sector for where they are drawing capital out of. So, my argument is we need to take a much broader view on what we are trying to accomplish with a Community Reinvestment Act and what the obligations of a sort of banking-based financial system is, and who are the players in that need to be participants. And we ought to be looking for new allies as opposed to new adversaries.
And I would just say, Aaron, that the CRA regulators tried a baby step version of thinking about that, and they've gotten beaten down. So
it will not be easy.
So Oswaldo, let me get Diane in here first, and then you, and then we'll see if we have time for one more lightning round question here. Diane.
I had to turn off her video, but I believe she's still here.
Do we still have you, Diane?
We might have lost her.
Oh, okay. All right, Oswaldo, go for it.
Yeah, I just want to clarify that. I mean, I tried to preemptively answer to your question. I think that it's in my presentation. We need to diversify from them, and also I just want to be emphatic that the way the things were before the political change wasn't working anyway. This oligopoly that I tried to, for lack of a better term, wasn't sufficient to supply capital to the CDFIs that are growing. The model didn't work, was exhausted as it was. It is great for nascent and early stage CDFIs, but other than that, it's not sufficient. So we need to start exploring and perhaps accelerate that conversation. I think the answer, Mark, is just to be prepared to access more sophisticated channels of capital. That's the only answer.
Thank you. So I'm going to go to one other big level question, and then we're going to say our thank you. So this is sort of a lightning round. Take a minute or two if you can, which is there's a question someone put in there, which I've sort of reinterpreted a little bit, which is how do we work with this administration? What can we do? There's lots of folks, going up to the Hill, and there are lots of folks trying to meet with OMB and all that sort of stuff. And I just a quick note that back when President Clinton left and President Bush II came in, we talked about having to learn to talk Republican, and we did a lot of work to that. It wasn't an obvious thing. It worked over time. That's why we have bipartisan support now. But just quick thoughts on that, and a minute each.
I can address that very quickly at the risk of tripping myself on my own words. But I think we need to change the script, and I always believe so. I think that the idea of leading with identity politics and CDFIs with a Democratic and a Republican administration is not a good business. We need to be agnostic as to who we serve. We need to serve the underserved. We need to go to rural areas. We need to go to south, north, east, and west. And we need to move our narrative to economic growth rather than many other disparities that we have many in this country. We need to be almost agnostic, or intentionally agnostic as to who we serve, not with a controversy. I'm saying I'm oversimplifying a big issue, and it's not to be able to work with the Trump administration. It's to be able to work with the political system we will have, right? Because that's what corporations successfully do.
Thank you.
A little bit overdoing it in the last 6 months, but from the corporate class. But we need to learn how to be economics engines of growth rather than any other political instrument. That's my answer.
Got it. Thank you, Aaron.
Very quickly, Mark, I will say that I think we need to remember that the administration is not like a multi-headed monster that like lives in the fourth dimension. These are people who live places and are from places. And this group of people, I would bet, represents or serves organizations in basically every district where folks in the administration have lived and worked. I think we have been too reliant on our trades to tell a macro story when the reality is we are in communities. And I think the work that CDFI Friendly America did, NAL, OFN, CDBA, et cetera, on getting the bicameral Republican-only letter is good evidence that that is a winning strategy. Even if that was a congressional strategy, we have to tell our story to our people in our places. And I think that's the answer.
And I would emphasize that one of the things we discovered with our data at the CDFI advocacy map is that Republicans take $2 roughly for every dollar that Democratic represented districts and states take. So there's a lot of ammunition there. There's a lot of reasons for that, which are worth exploring. I'm going to wrap us up. Unfortunately, Bree, did we share the results of the poll or not?
Yes, I did very briefly. Great. I think I can put them back up though.
No, it's okay. It's staring me in the face. But I think CRA and consolidation in the CDFI industry are likely to be our next couple of sessions. We'll work on them. But I want to say thank you first of all. Diane had to leave, but thank you, Oswaldo. Thank you, Aaron, for really doing everything we could have hoped for and then some, and really helping us to think about some of the big issues. It's part of a bigger conversation. We will continue. Thank you to everybody who came, and we still have a large number of people who are here, for wanting to be part of this conversation, for weighing in, for asking questions. We will do our best to follow up. We realize now that this is a bigger project than we thought it was when we started it. And we are going to find ways to get answers to the range of questions and to share information. Again, the goal isn't for us to do something with this. The goal is to help you do something with all that we're learning and all that we're doing. So look for communications from us starting tomorrow with a thank you letter for being here and a survey and some other things, as well as links to the recording and a link to the page we set up so that you'll find the resources.